start credit underwriting from today onwards. Okay, and we will start our session from here. Proposed monthly payments for property. Okay, proposed means something. If I applied for a loan, what is going to be my monthly payments for the property? Okay, so when I say property, right, here is my property. Now I want to purchase this property. Not yet purchased. I'm planning to purchase. The property value is 300,000, right? This is the appraised value or property value, right? Now, I negotiated with the seller and he agreed to sell it to $290,000. So that is what our sale price. Okay, property value is 300, but I negotiated and he is ready to sell it for 290,000. So sale price is going to be 290,000. Now, in my bank account, I have almost $90,000, right, as a saving. So I need a loan approval. So loan amount, obviously, I will look for 200,000, right? Or maybe lesser or maybe higher, but at least 200,000. So what is going to be my LTV?
200 loan amount divided by sale price.
Very good. Okay. So 200 is what my loan amount?
68.96.
Okay. Divided by the lesser one, that is purchased amount. So 68.96. 68.96 is what my. But then I found that I cannot consume all my 90,000. So I need the higher loan. So let's say I'm telling I will go for 250,000 loan amount. Now what is my LTV? 250,000 divided by 290,000. 86.25. So is there anything that is going to be excluded or included?
Yes, sir. Now PMI will be applicable.
Right. Then now, since it is let's say it's a conventional loan. So in the conventional loan, whenever our LTV is more than 80%, then we need mortgage to be insured, means private mortgage insurance. That is what we need, right? And then we need to pay the premium. Okay, for that. Let's say I changed my mind. My loan amount is still going to be 200,000. So it is 68%. Do I need any MI? No, right? But now I'm also going for a big loan or additional loan, second loan. Second loan amount is, let's say, 50,000. I'm saying that I will take another loan for 50,000. Second loan. Now, what is going to be my CLTV? LTV is going to remain 68%. But what is my CLTV? 200 plus 50,000. 250 combined loan to value is 250 divided by 290. 86.86%. Now, do I need to go for MI? Because my CLTV is more than 80%.
No, sir.
Why? It's more than 80% now.
LTV is a 68% only.
Okay. So MI always belongs to or apply when LTV is more than 80%, not the CLTV, right?
Yes, sir.
Okay. So CLTV doesn't matter how much it is 95% or 97%, but LTV is less than 80%, we are good. We need not to go for MI. Is that clear to everyone?
Yes, sir.
Okay. So now, this is my property. Okay. Number one, principal amount. Principal loan amount, right? Principal, then interest, right? Principal and interest. These are the two expenses that is called mortgage payment, right? Is there any other expense that relates to this property?
Yes, sir. Taxes, insurance will be there.
Right. So when we calculate DTI, debt to income ratio, so there are two type of ratios. Number one is housing debt to income ratio. Okay, housing debt to income, and number two is total debt to income ratio. These both will be always represented as this much, like 40 by 40, maybe 46%. The first is going to be our housing debt to income ratio, and the second going to be total debt to income ratio. So there are always HDI versus DTI. These are the two, representations. HDI only shows housing debt to income ratio. That means it will include all the property expenses. Okay. DTI belongs to total debt. Whatever other debts, that will also be included. That becomes the total debt to income ratio. So always there are two types of DTIs or ratios, right? Number one is HDI. HDI means housing debt to income, and other is DTI, total debt to income ratio. Now HDI is also known as front ratio, and DTI also known as back end ratio. Okay, these are same. HDI also known as front ratio, DTI also known as back end ratio. Okay, now when I say HDI or my front ratio, how to calculate front end ratio or front ratio? Everything and every expense that belongs to the property, like your principal plus interest. What other expenses that belongs to this property? Property taxes, right? Then I told you that every property in the US, like in India, we have to have vehicle insurance, whether it's electric scooter, it's bike, or it's four-wheeler or truck or bus, whatever, right? You cannot ride any bike, any two-wheeler or four-wheeler. You cannot drive any four-wheeler without having insurance. Similarly, in the US, any property that will have a loan, right, they will always have an insurance. So that is called home owner insurance, right, or property insurance, right, or it is also known as hazard insurance. It is also known as fire policy. These are different names for that, but the same is main is it's a property insurance or homeowner insurance, also known as HOI. HOI stands for homeowner insurance, right? So 1, 2, 3. These are the three that is gonna always exist with the property. Whenever we are going to say that borrower has property, right? So there must be some expenses. Yes, there are going to be expenses. So we need to calculate, we need to consider principal plus interest, property taxes, and homeowner insurance. Everything needs to be considered. Plus number 4, if you have mortgage insurance, if your DTI in conventional loan is more than 80%, then you will have extra insurance, mortgage insurance, private mortgage insurance. In FHA, in government loan, it will always exist because that is upfront mortgage insurance. So obviously the sum amount need to be paid in upfront, and then there will be monthly premium as well. That also need to be paid. So there will always have a mortgage insurance. But in conventional, this will only apply when your DTI is more than 80%. LTV, sorry, not DTI, LTV is more than 80%. Then there could be another expense. If there could be another expense, is there any possibility? If you can remember anything? Or these are the 4 that belongs to this property.
Housing expenses.
These are housing expenses. Yesterday we discussed about PUD properties, right? And
Yes.
condo.
Association dues.
Right. So condo and cooperatives, those always will have these type of properties, always will have additional expense, and that is HOA dues. HOA dues means homeowner association dues. These are the minimum five expenses. If somebody has more expenses, means somebody could have a second mortgage as well. So second mortgage, insurance, not insurance, second mortgage, principal and interest will also apply, right? Second mortgage, payment, we can say payment means principal, and these are the 5, or principal and interest, property taxes, homeowner insurance. These are the 3 always exist on property. Mortgage insurance will get applied if our LTV is more than 80% in a conventional loan. HOA dues if our property is PUD, condo or cooperative. This is what called short form PITI. PITI means P for principal, right? I for insurance, T for taxes, and I for, what is I? Sorry, this is not in principal, interest, taxes and insurance. This is PITI. Sometimes it will become PITIA, and that is for association dues, right? So PITI, when I say what is the PITI for this property, that means I am asking you the consolidated amount of principal plus interest plus taxes plus insurance and association dues if it exists, if it applied. This is called PITIA. Clear to everyone what is PITIA?
Yes, sir.
Principal, interest, taxes, insurance and association. Any property, whenever we consider any property's expense, these are the minimum expense that we always need to see. If somebody is giving us only principal and interest, that this is my mortgage payment, we also need to check if you have a property, then it is not only principal and interest, but taxes, insurance and association dues will apply also. So provide them also. Then consolidated amount is going to be that property's expense. Okay. What is the formula to calculate HDI? Formula to calculate HDI ratio is your PITIA divided by total income. Okay, total income.